This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant content in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the future of Microsoft as a rebound in cloud spending paints a very positive picture for sales growth in 2024.
Plus, what happens to the £1.8 trillion UK pension fund post-fiscal U-turn?
But first, Kroger's planned acquisition of Albertson offers some big opportunities here for a combined entity that could drive revenue and earnings growth, but it also comes with some hurdles here. So for more on the merger's long road to completion, we want to welcome Jennifer Bartashus, Bloomberg Intelligence Senior Consumer Staples Analyst. Jen, first of all, walk us through the actual M&A here. Why would Kroger want Albertson, and talk us through the logistics?
It's an interesting deal on paper because we look at where Kroger operates and where Albertsons operate. There is some distinction in there in those main areas. And so by putting the companies together, it would really create a national footprint for one retailer. And if you think about their company cultures, they're very much focused on the same things, which is developing loyalty programs, developing a digital platform, and really improving their fresh offering in their grocery stores. So there's a lot of similarities between the two operators.
But there's also some overlap there. So I would think from a regulatory standpoint, it's going to be very tough to clear regulatory scrutiny. But if it does, I'd have to sell some stores. Is that a big issue, a big hurdle?
It is definitely a big hurdle. Because they are both reasonably large retailers, putting them together, there are certain markets where there's a lot of overlap. And so examples of that would be the Chicago area with Jewel Osco and with Mariano's and Food for Less. You've got areas like in Texas, in California, in the Northwest states. So those are the areas that the FTC will probably be looking at most closely. And in order to try to offset any of that concern, when the deal was announced, what they said they were going to do is create a spin-off company where they would include anywhere from 100 to just under 400 stores to try to alleviate some of that overlap concern. But that's still only in the planning stages, and it'll be very interesting to see how that plays out.
What about the technology behind the deal? Is there going to be integration challenges on that front?
Well, we're expecting actually really significant integration challenges. Both of these retailers have invested heavily in the last 5 years in developing their own technologies, and those systems are not compatible because they were self-developed. So the risk that Kroger really runs here is that their management team could very much end up with a split focus with trying to focus on integrating these very disparate systems and still then executing on their existing plans to continue to grow so that they stay competitive against companies like Walmart or even Target for that matter.
So talk to us about the benefits of scale in the food business, the supermarket business. Like if I own 500 stores and then I buy another 500, so now I've got 1,000. Is a quart of milk cheaper for Kroger's to buy from its wholesaler?
Absolutely. And that's why scale plays such a big role across all of retail these days. And so what you really gain is purchasing power. And so when you're buying for those 1,000 stores, as you said, Paul, all of a sudden the cost per unit can come down because you're ordering much larger quantities. And then that allows these retailers, in principle, to then pass that through to customers so that prices are competitive for customers. But back to that competition front, one of the concerns is that, with these combination of these two retailers and then, the other big food retailer out there, which is Walmart, you're going to have a lot of market share tied up with only two companies. And so there are some consumers out there who are worried that this actually won't translate to lower prices, but actually could translate to higher prices.
Well, it's like the Walmart thing, right? Like they have much more negotiating power because they're just like so huge.
Exactly.
So is this deal going to go through? Like, is the government going to like this deal?
It's hard to say. I mean, there's been a lot of signals from the Biden administration about really looking at, industries where there are very few big players. The meat industry is one that we've heard a lot about. And I think traditionally the FTC looks at these kinds of approvals on a very regional basis. So they would look at it market by market and determine whether there was enough competition there. But the idea of this becoming a national grocer and a national scale, Walmart holds roughly 25% of market share for all grocery in the United States.
Wow. If
you combine Kroger and Albertsons, those together will be about 13% of share. So when you put that together, you're talking about nearly 40% of all market share in the hands of only two companies. And that's where we see the FTC perhaps having some reservations about approving the deal.
All right, here's a critical question. Self-checkout. I have to admit, I was not a fan. I like when people wait on me. I do much better there. But now I'm doing it more and more.
I like it when Paul joins the 21st century.
Oh, exactly. So does that mean they have less labor costs maybe? Because I'm doing the checking and the bagging, by the way.
Yeah, it is definitely part of the idea of controlling costs. And so you'll see more and more of those lanes are self-checkout and fewer are, staffed by cashiers. It's been a trend across all of retail where they're just looking for any way they can to reduce labor costs or costs of any category for that matter, but something that is also perceived as a convenience for customers because, ironically, Paul, people feel like they can check out faster themselves, but
right.
If you actually timed it, usually the cashiers are faster.
Yeah.
So it's one of those perception things, but it works in the favor
I have a little
of
problem with the
retailers.
whole bagging process.
Yeah, my husband and I get into so many fights when we do
Yes,
self-checkout
right.
because we both think we know how to do it better. Hey, Jen, we'll have to leave it there. We really appreciate it. Jen Bartashus, Bloomberg Intelligence, Senior Consumer Staples Analyst.
All right, coming up on the program, how Microsoft's Cloud Catalyst can lift it above consensus in 2024.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Well, Microsoft's 2024 looks brighter than consensus, and that's according to Bloomberg Intelligence, despite weak economic conditions that continue to hamper the company's 2023 sales growth. For more, let's bring in Bloomberg Intelligence Senior Software and IT Services Analyst Anurag Rana. All right, Anurag, technology, it's been the growth story for this market for as long as I can remember. We do have some tough economic conditions out there globally. We've got a strong dollar. Talk to us about Microsoft. What's the story behind the growth there at Microsoft?
Surprisingly, it's a very simple story. It is not that complicated in my view. When you look at Microsoft over the last 5 years, in constant currency, at an average, they have grown about 16% a year. And that's pretty phenomenal because the software industry grows only about 10 to 12%. And the reason that they're growing that well is because they have a bunch of cloud products that are doing pretty well. Office 365 is doing well, etc. So now when you look at consensus for next year is at 13% or 13.5% growth in constant currency. And I think that's very fair given that, economic conditions are weakening. Who knows what tech budgets are going to be over the next 12 months. Mm-hmm. We should see some softness. But even in that softness, you could expect Microsoft to grow 10, 12, 13% because, you still have to upgrade your PCs in some cases. You have to upgrade your Office devices. So from that point, I think 13% is very fair.
Is it valued at 13%?
It's tough to say that because, the valuation part really dictates where the short end of the curve remains from an inflation point of view and interest rate point of view. If interest rates do not rise much more than what we are projecting over the next 6 months, then tech in general will be happy. But when you look at, if inflation keeps on rising and they keep on raising rates, and then tech may be in trouble. So it is not so much dependent on Microsoft, but dependent on the interest rate cycle.
So the cloud, how big of a business is that in terms of maybe contribution to revenue percentage? Because that's kind of the growth story for a lot of investors.
Exactly.
And how big is it now and how big do you think it could get for them?
So when you look at Microsoft had two pillars for the longest period of time. One was Office business and the other one was their Windows business, dependent on the PC sales.
Yep.
Now that has been the case. Now, if you go back in even just not that long ago, just 5 years ago, commercial cloud business, which includes Azure, LinkedIn and Office 365 commercial was only about 17% of total business. Now, when we look at it now, it's getting closer to 50%. And our analysis shows that in 2 years, it's going to be somewhere, north of 55%, closer to 60%. In that case, Paul, if you look at from the Azure business, It's growing above 40% right now. Alex, I would say in a couple of years, it will still be in the 30s. Wow. So when you look at that big of a revenue growing at 35%, it's going to take the whole company average easily towards the 12 to 15% range.
So you mentioned sort of the global macroeconomic uncertainties. If we hit a global recession next year, how does that impact Microsoft, for example?
So in the case of Microsoft, I think the consensus looking at only about 12-13% revenue growth is fair. Because what typically happens in a year is a large enterprise, let's say for the sake of argument, Pepsi or a JP Morgan, will have a multi-year agreement with Microsoft that they're going to spend an X amount of dollars anyway with this company. This company does not depend on people selling products every day. You still need to run the normal day-to-day.
You're not sending like an iPhone to somebody.
Yes, exactly. You have a data center. You got to run that data center. Now you may push out an upgrade for the year after that. So we are saying that the 200 basis points or the 300 basis points below the average is a fair number. Maybe it goes down another 100 basis points, who knows? But, this is a company that I think can still grow 10% in a recession. But this is the kicker, and we saw that during the pandemic. Whatever revenue that you lose that year, you actually get back and more the year after. Because it's not as if that you don't need these products. You have to upgrade them one time or the other. So the next year, you come back with higher growth rates.
All right, like a lot of the companies that you cover, Anurag, this one has an embarrassment of riches when it comes to free cash flow. I'm looking at the forecast here on the Bloomberg terminal, $70-80 billion of future free cash flow. What do you do with it?
So the thing is, now there is, the Activision deal is still pending. So there's some of that money is going to go to that. And that would be perhaps 1 year of free cash flow in this case. But the next year, I would expect them not to take that many acquisitions because I think it's going to get harder for them. I would be looking at more buybacks, at least at these prices, for them to actually accelerate that. I think next week is going to be a big test for a lot of tech companies is have they actually increased their buyback.
At the same time, I feel like, especially for big tech and multinationals, we're going to hear a lot about the currency headwinds, et cetera. And I know your projections are on a constant currency basis. But what are the key numbers we have to be watching for in terms of FX?
Well, I think FX, you should see a massive hit somewhere in the 600 to 800 basis points. So 6 to 8%.
Yeah?
I mean, it is a lot. But what happens is it's more of a translational thing. So, for example, let's say for the sake of argument that they're selling a product in Europe. They're going to sell that product in euros to a European company. So for my side, I want to see what the constant currency growth rate in that geography was. The translation part of it does not affect the cash flow that they generate in that particular area. So it does, but I said this a few times before, in the long run, it does have an impact because let's say you're a European company and you yourself are not making that much money because of the economic conditions, whether you will spend that much on technology, which by far is still priced in dollars on a reference point basis. That may be in euros when it comes to the translation, but that product is a little bit more expensive for you at that point. So I think that comes next year.
Anurag, this stock has been a beast here. Over the last 5 years, compounded annual growth of 26% compared to the S&P at 9%. Is it still a bullish call out there when you talk to your institutional investor clients? Is this just one you put in your 401k and just walk away?
So the bear case for all technology companies has been that they go through the ups and downs, unlike a Costco. I would argue that Microsoft is probably in a better position today than any time in history to capitalize from any other emerging technology that's happening out there. They have now 3 big pillars. The PC business is still very strong and bigger than it was 5 years ago. The Windows business, the Office 365 business is also very strong. And now you have a cloud business. Yep. So when you say what's going to happen next 10 years, these guys have their hands on the biggest digital transformation initiatives that are happening. I don't see a reason why this company is not going to grow between 10 to 15% at a stable rate over the next 3 to 5 years. If they can grow at 15%, which means doubling the size of the company in, I would say a little over 5 years then.
In this environment, the description that you just gave, what's a true competitor to Microsoft?
Oh, it's a very hard question. On the cloud infrastructure side, it's Amazon Web Services. On the application side, it's Salesforce.com. So those are the two that I would highlight. Oracle is slightly on the periphery, but Oracle has its own things that they got to figure out.
All right, I'm going to sleep well because this thing's probably all over my 401k. All right, thanks to Bloomberg Intelligence Senior Software and IT Services Analyst Anurag Rana.
All right, you're coming up on the program. We're going to head across the pond to see how the UK is handling its pension problem.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies in 130 industries worldwide.
The UK government's fiscal policy U-turn eased market volatility, but it did leave a lot of questions about the £1.8 trillion pension industry. So let's dig a lot deeper into this. Bloomberg Intelligence senior EU insurance analyst Charles Graham. Charles, we know the headlines. Give us the story. What problem did the UK fiscal crisis unveil in the pension industry?
What I think we've discovered in the last fortnight is that the solutions that the pension industry has been using to manage sustained low interest rates, while successful on one level, also gave rise to a degree of systemic risk on another. So what we've actually faced in this period where we've seen interest rates begin to rise is a liquidity crisis. So the liability-driven investment strategies that many of these funds have used protected them successfully by using derivatives against inflation and interest rate and currency risk, and enable them to invest in increasing quantities of illiquid assets to boost their investment returns, since the derivatives were only partially funded. But when we saw this reversal in interest rates, we actually then began to see margin calls. And that was happening before the mini-budget in the UK a fortnight ago. But when the mini-budget crashed the gilts market and the currency, then they began to face margin calls which were substantially larger than the cash resources they had to meet those payments.
Charles, was this well understood at all by the market? It wasn't by me, I can tell you that.
There had been warnings that the margin call issue was out there, the Bank of England and so on had raised concerns about it. But I don't think anybody expected us to see, the size of swings in interest rates that we've seen and in gilt yields. The value of gilt yields dropped so much. And obviously what we ended up with was a situation of sort of emergency calls for capital from sponsors, and also funds finding themselves into a position where they're actually selling assets into a falling market, including some of the gilts backing these derivative contracts. And that's what forced the Bank of England to intervene.
So going forward from here, it seems like there's a couple options. One, you have to reform the pension industry, or two, these pension funds aren't going to be able to meet the obligations that they have if they can't take on certain risk and leverage up to do that.
Well, the irony in this is the actual funding position improves because of the rise in gilt yields and therefore increasing discount rates on the liabilities of the pension funds. So this is very much a liquidity problem and hopefully a short-term one. But it has seen, a significant sale of assets in order to be able to fund these cash calls, these margin calls. And, in a sense, it's not over because while we've got through the immediate crisis and we bought some time, we know we have a budget coming up which is going to be properly costed on 31st of October. And then shortly after that, we're going to find out what the Bank of England is going to do with interest rates in order to combat inflation.
Were any pensioners, I'm thinking widows and orphans, were real people injured by this, or is this just a funding crisis within the capital markets?
It's a funding crisis within the capital markets, but it's, 1.8 trillion of assets is a big chunk.
Yep.
So then I guess the question is, what happens from here? Like, I understand that liability longer term goes down. Presumably the margin calls are ended to some extent. But when we see the BOE having to actively start quantitative tightening, and I appreciate that they're going to leave the back end alone while they concentrate on the front end, do we know the potential for another kind of crisis or risk in this area yet?
I don't think we do, but what we do know is that there's going to be, I suspect, a regulatory review of the levels of liquidity that these funds carry, and also an investigation into how heavily leveraged they'd become. And looking forward, there's a further problem from the UK government's point of view, is that if you look at the gilt market, insurers and these pension funds have about 28% of the gilt market, about 29% is owned by overseas investors, and 33% is currently owned by the Bank of England. And these defined benefit schemes are virtually all closed to new members, aren't growing. So where the demand for gilts comes from, as the Bank of England looks to unwind some of its holdings, is not immediately obvious.
So, Charles, were any publicly traded companies really impacted by this at all? I'm thinking about some of the big money managers of BlackRock, for example. I mean, was it felt in that part of the market?
Well, the likes of Legal & General, BlackRock, Insight, Schroders to a lesser extent, have been big players in the development of these liability-driven investment strategies. And what we're not entirely clear about is how much of these funds have actually had to be liquidated in order to meet these margin calls. Mm-hmm. So that, I think, will come out in time, as will whether or not any of the sponsors of these funds, which include some of the biggest corporations in the UK, actually had to inject capital in order to enable them to meet some of these payments.
Ugly. I just feel like there's just more questions than answers, and everyone's like, oh, it's going to happen here. Well, it might not, but it can happen somewhere, yep. I think is the point that we've learned due to all the leverage. Hey, Charles, thanks a lot. Really appreciate it. Charles Graham, a senior EU insurance analyst from Bloomberg Intelligence.
Coming up on the program, we take a look at the state of CCC corporate bonds.
All right, you're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Every market participant is trying to find out where the recession is priced most accurately, and most everyone is looking at any kind of cracks within the corporate credit market. Well, CCCs might have yet to realize cycle lows, but in the medium term, things might not look so bad. Let's get into that call from Noel Hebert, Bloomberg Intelligence Director of Credit Research. So many say that equities might be priced for recession, but the credit market isn't. CCCs are the junk of the junk. What are they telling you?
Well, they're not telling. I mean, they're telling us that things are a little bit stressed right now, but you haven't seen sort of that real disorderly sell down that you would typically see when people are capitulating, right? So at the end of a cycle. And in fairness to them, right, I mean, we haven't really seen a lot of like sort of the actual recessionary data flow through yet in terms of earnings and whatnot. So we're still sort of early phases here.
So is that because we've just had so much fiscal support in the marketplace over the last several years that there's kind of a cushion there for some of these credits?
Well, I think there's a couple of factors at play, and I think that's definitely one of them. I think the other thing that you get going on in credit markets, more broadly speaking, is we haven't seen treasury yields where they're at in a long time. So people are looking at the nominal yields on a lot of these asset classes. In investment grade, you're seeing 6% coupons, and in high yield, you're seeing 8, 9, 10, 12, or in CCCs, 15%. And I think people sort of get a little gobsmacked because they haven't seen that in such a long time. So they start looking past maybe the underlying fundamental piece of it that would be there in spread. And then I think the other piece of that, which is sort of derivative to what you were saying, Paul, is that people keep wanting to anticipate, well, when will the Fed crack, right? When will they pivot? And they don't want to miss that move because corrections, particularly down in credit spectrum, happen very, very quickly. So you don't want to miss it when it happens.
So based on that, are there areas of the CCC market that you do want to be buying right now versus others where you want to be more cautious?
Yeah, it's kind of a tricky question to answer, really. I mean, because the CCCs, particularly sort of in these early phases, ends up being very barbelled, right? So you've got some names that are trading, so if you're talking about overall spread being 1,100 basis points, give or take, right, you're going to have some names that are going to be 4,000, 5,000, 6,000 basis points, right, like Diamond Sports or whatever. And then you're going to have a whole host of companies that are sort of better credits that are maybe 600 or 700 basis points. So I think depending on how you view the credit cycle and where you think we're going with recession, there's always pockets within CCC where you're going to pick up that extra yield, which is sort of that stronger quality piece. Whereas dollar pricing is how you're going to evaluate the rest of the curve, and so you're going to be thinking about recovery. So if you're looking at somebody you think maybe is going to have to file for bankruptcy or restructure, then you're doing a different kind of analysis saying, I think it's worth 20 cents on the dollar and it's trading at 35, so I've still got a little bit of room.
Hey, Noel, I've had a lot of smart fixed income folks like yourself kind of tell me we've never seen these negative returns like we've seen in the fixed income market here in 2022. So when, a simple equity guy like me hears that, I call up my broker and say, let's go buy some bonds. That's probably not the best analysis, is it?
Well, Well, I mean, the flip side of it is preceding this, it had never been that good, right?
Yep.
So I think it's the flip side of the same coin. So, I mean, rates kind of came from such a unforeseen low, particularly when you talk about like real yields, right? The huge negative real yields that we've seen. So I think, it's part and parcel to that. That said, I think one of the things, if you think about it, really depends on horizon, right? If you're an intermediate to long-term horizon investor, and this is true for investment grade as well as high yield, right? The current carry, historically speaking, right, if you've got 12 or 18 or 24 months, it's very hard to lose money with yields where they're at right now, even if 3 or 6 or 9 months down the road, it might not feel so good.
Okay, so let's go 3, 6, 9 months down the road. Do we see the default cycle that we've kind of been waiting for since 2015?
Yes, I hope so.
Well, okay, then what kind of default cycle do you think we're actually going to see? And why is this time different?
So from a purely statistical standpoint, right, so people like to interpolate what the implied default rate is by using spread in the marketplace. And spread tends to anticipate the actual physical default cycle by, call it, 9 to 12 months, right? So what spreads would be telling us in terms of when they really started correcting earlier this year is that by starting at the end of 4Q and through the first half of next year, we should see the default rate move from sort of around 1% now up into sort of the mid-single digits. So 4 to 6% is sort of the neighborhood that I'd be looking for.
Noel, I feel like this discussion with you is just a precursor to a discussion we may be having with your colleague Phil Brendel, who covers distressed debt, and that's a discussion we might be having in 6 to 12 months. Is there going to be a lot of names going into that distressed area, do you think?
Yeah, I believe so. I mean, because you do have a number of names that are already sort of struggling, I think, to sort of figure out what their capital structure is going to look like. And that's
right.
Even before, again, a lot of these impacts from higher rates are flowing through, let alone the margin compression from the economic trends that we're seeing. So we've seen, names like Talon and Revlon and some of these guys already kind of go through, but that is definitely going to be a trend where as we move into year end, people keep talking about Bed Bath & Beyond as maybe being sort of an early 2023 type of name. And there's a few more of those out there.
Okay.
Great stuff. Noel, really appreciate it. A good setup for us. Noel Hebert, Director of Credit Research for Bloomberg Intelligence.
All right, now let's turn to the municipal bond market, one of my favorite areas, where municipal bond rates, they seem to be ignoring moves in U.S. Treasuries, and new supply continues to hide. To explain this, we're joined by Bloomberg Intelligence Senior U.S. Municipal Strategist Eric Kazatsky. Eric, we've just had crazy performance. We'll call that volatility for the smart kids all across the fixed income space. Just give us a sense of what the year's been like. How tough has it been for municipals? And maybe is that a safer place to be, maybe?
Well, it's a safer place to be as far as returns. And when I say that, I mean I'm comparing returns versus like-rated corporates or other areas of fixed income that have gotten hit a lot harder this year. And look, people are still getting their muni statements. They're looking at red on their statements, losses of 11, 12% for the year, which is not great. But it's that sleep-at-night money. It's stuff we talk about all the time. It's steady streams of income, and that really hasn't changed for the space at all.
Do you expect it to if we get a Fed terminal rate above 5%, for example?
A lot of things have changed over the last 2 years, and we could sort of point to historical correlations and not to get too far down a math rabbit hole. But, prior to 2020, the correlation between 10-year municipals and 10-year Treasury was probably like 70%. Right now it's at 40%. So there's really a big disconnect with where Treasury rates are traveling, and they're going up to a larger degree than muni rates. And a lot of that still has to do with the demand in the muni space, that people are still seeking that tax-exempt income. And that's really sort of keeping a cap on rates going higher right now.
In terms of new issuance, one of the things I've learned from reading your research and talking to you, Eric, is that municipalities aren't necessarily market timers. They just kind of raise the money when they need it, as opposed to saying that, boy, over the last few years, rates have been rock bottom. Let's go out and issue a bunch of debt. So what do you expect new issuance to kind of look like? Well, what's it been year to date, and what do you expect it to be kind of going forward?
Yeah, I mean, so you're right. I mean, in past periods of higher rates, municipalities have sold debt, right? I mean, we haven't had low rates, for the last 40 years, and there's been different periods where supply has sort of waned and come back in vogue. Right now, it's down about 20% year over year, and that really has sort of put a blow in a lot of strategists' expectations as whereas sales were going to be this year. I think there was a very bullish coming into the year as far as like where muni sales were going to end up. I don't think until we get some sort of clarity or when the Fed is going to pause that you're going to see supply come back in a meaningful way to the muni space.
On the flip side, when we have a big risk-on kind of move and growth is doing really well, do investors dump a lot of munis and then go elsewhere, or when they buy, are that stickier?
No, it's much stickier. And actually, you're seeing retail come back in because you're getting structures that they've been sort of waiting on the sidelines for years. You're getting 5% coupon income at discount prices. And that really is sort of like in the wheelhouse of a lot of retail investors, right? Because they're locking in that 5% coupon, which is around about 8% after-tax rate, and locking it in long term. So, it's that sleep-at-night money, low default from a statistical standpoint, especially if we're heading into a recession compared to, what could happen on the corporate side of things.
Well, that's kind of where I wanted to go, thinking about credit quality, because I'm sure you, like a lot of analysts out there, have been running recession models, if you will. Again, I mean, there's so much liquidity in this marketplace. There's been so much support during the pandemic from the federal government. Is it expected to be a relatively low credit default period if, in fact, we do go into a recession? Or is this something we really need to be concerned about?
I don't see a lot of concern from the market right now. I mean, and we could just sort of tell that market sentiment based on where credit spreads have gone for the year, especially in high yield munis, right? Sort of the hairier part of the asset class. Spreads really haven't widened more than 20, 30 basis points since the beginning of the year, which seems to signal that there's not a lot of stress as far as sentiment from the investor standpoint. If we slide into a recession, if we're not already there, do we expect that to widen more? Sure, because we're about a standard deviation lower than the historical average. So I would think, believing in mean reversion, that we're going to see that move wider. But as far as just generic IG, state and local credit, going into a recession, I think a lot of them still have a lot of cash in their balance sheet, and they're ready and willing to raise taxes.
Default issue. What's the risk on the default meter?
You know what? We're seeing volumes that are sort of in historical norms, about $2 billion for the year as far as muni defaults. So nothing that's really raising the radar. And they're all in areas that we have typically seen, right? Higher ed projects, senior living homes, stuff that is just like new construction projects that are just coming out of their capitalized interest period. You can point to Mall of America as a perfect example of that, right? New construction project that's just not meeting expectations. So things like that are really sort of falling in the default buckets.
One other sector that I want to talk about is higher education, because the last of the Sweeney children are in the market for college. So I'm thinking about the finances of some of these schools and things like that. I mean, just education in general, what's that group been like?
It's been fairly strong, but it also depends on where in education you're looking, right? State school systems that have historically been funded through recessionary periods and have strong support from their constituents, they're going to be fine. Schools that are private and have strong endowments, very good credit, right? We're talking about the standalone colleges, some of the ones that have seen falling enrollment even before the pandemic. Those are the ones that are going to struggle the most.
All right, Eric, thanks a lot. We really appreciate it. Eric Kazatsky, Bloomberg Intelligence Senior U.S. Muni Strategist.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.